Joining us right now, let's bring in the team. We've got Adam, Dom, and Julie with us. Also, Jack Ablin of Harris Privates Bank. They oversee about $55 billion in assets. He is currently, by the way, underweight equities because he says the risk environment is too high. So underweight equities, when you talk about the risk environment, I mean, what, take your pick at this point, Jack? Because there seems to be a lot of concerns obviously still out there.
There is, and it's really not that we're betting against the stock market, Carol. Really what it is just given the volatility, given the environment, we'd really better serve sitting on the sidelines. We're not sitting idly in cash. We've actually bought a lot of the trust preferreds, a lot of the bank preferred stock, although what I hear is they're going to get all redeemed pretty soon. But for right now, that's where we are. What
are you really worried about? I mean, like I said, I can give you a laundry list, but I found it interesting kind of the reaction to Europe this morning because, you know, we know that there are debt problems over in Europe, yet, you know, the markets, investors kind of seem to come back here, certainly from the holiday here in the United States, and like we're reminded of it and have put pressure on the equity trade. What's the biggest risk out there and what's really new?
Well, nothing's really new, Carol, but I do think there was a sense of complacency in August when we were in a no news is good news environment in Europe. The problem is the entire continent goes on vacation in August, and so we shouldn't have expected any news out of Europe. So now that they're back from vacation, we'll likely hear hear more development. So I do think there is somewhat of a headline news risk coming out of Europe over the next couple of weeks, and one we want to pay pretty close attention to.
Well, I just wanted to mention, I mean, it seems like people are still on vacation. We've been looking at the volume here right now, and we're only around 5.7 billion shares here. We might be the lowest of the year. Jack, what are people waiting for? Is it because we've got the Jewish holidays at the end of this week and people are waiting until next week to start to put some money on the table or take it off in any volume degree here?
That could be. I mean, with the Jewish holidays coming up starting tomorrow, there could be people just not, in the office working this week, perhaps. But I think more is the fact that there's just still all of this uncertainty around, and one that prevents entrepreneurs and business leaders to commit. Is really the same uncertainty that's preventing investors to jump in with both feet.
Yeah, we're definitely seeing that play out in today's trading. I do want to head out to the CME Group. Michael Seery, CEO of SeeryFutures.com. He actively trades futures. Mike, I want to bring you into this conversation. Do you care at all what the president has to say tomorrow in terms of his proposals for helping out the economy?
No, not at all. I just don't believe it. Another $250 billion going to be spent. I mean, some of it could be good on roads and railroads and stuff like that. Infrastructure, I don't mind that, but still a lot of money that we don't have that we're going to be spent. Might be a short-term blip, but it's not going to do anything. It's only a quarter of a trillion. A quarter of a trillion to us nowadays is nothing.
Hey, Michael, it's Adam. Question: we could not get above 1,100 and stay there. Is it as simple as that? You send it back down now?
I think so. Yeah, I think, this 1037, we bounced off it 3 times last Tuesday and a couple days before, and then we rallied up to 1,100 and right back down. Like the person I heard before, it is really, really thin. I mean, there's just not a lot of excitement in the stock market on either side to push it lower or to push it higher. But something is going to get it out of this catalyst. But, commodity prices have really risen in the last month. Bond yields have really dropped in the last month. So there is money being put in other sectors of the economy.
Hey, Jack, it's Dominic here. Speaking of that, places to put your money in this economy besides stocks or anywhere else, you talked about this idea that you're not just sitting on cash, but you're going elsewhere, trust preferred securities. How attractive is the bond market right now? We hear bubble all the time. We hear about duration risk, things like that. Really, are bonds a safe place to be right now? Is that where you're putting money?
Well, I would say long-term treasuries are probably a dangerous place to hang out right now, given the fact that, there's so little yield, there's just very little margin to be wrong. I mean, if you consider that back in 1982, when I started in the business, the 10-year Treasury yield was 14.5%. Treasury yields could go to 17% before you lost money on a one-year basis. Nowadays, if interest rates rise by literally less than 0.5%, you would lose money on a year-over-year basis. And given that, we're seeing 50 basis point moves a month, that's easily attainable. So what I would rather do is stay at the front of the curve, either by bank loans, floating rate notes, or perhaps some high yield bonds, at least get some yield through credit risk rather than just pure interest rate risk on the Treasury market.
So, Jack, do you think that there's sort of a bigger picture, longer term change of perception about what a safe investment is?
I think so. I think the bigger picture, longer term perception is that we're out of this short-term cycle. The fact is Washington can no longer micromanage our economy. You know, what Greenspan was able to sweep under the rug for 2 decades and, you know, Bernanke was able to do for a little bit just is gone. We don't have the ammunition to do that anymore. And the reality is Washington is great for public policy and long term, but it really shouldn't be around to try to manage the day-to-day market moves. It just doesn't have the firepower anymore, and it really shouldn't have anyway.
Hey, Michael, it's Dominic back here again. Another question for you.
Yes,
We've been talking about these growth concerns coming out. One place that we have kind of seen a little precursor is in the crude oil market, right? It's not really been validating the highs that we saw in the stock markets last week. Are there any other signs you see out there that we could be kind of in this top-ish range for the stock market, at least short term?
Well, you know what's really interesting? We finally have decoupled. Crude oil has not followed the stock market in the last week or so, and commodity prices have finally decoupled. This hasn't happened in a couple of years. The only reason the stocks have had the rallies is because the commodities have had a terrific rally, and a lot of the stocks that own those commodities have gone up. Now, one interesting thing, though, if commodity prices do zoom higher, interest rates, they might have to force them up just to curb some of these commodity prices. We have deflation in some sections of the economy, but in some sections of the economy, we don't have deflation. Some of these commodities are sky high. Go to the store, go to the gas station. They're still very, very high. So there's 2 different sectors of this economy right now.
Well, when you talk about sectors of the economy, if you look at the housing sector, we definitely see still a lot of pricing pressure and deflation there. Guys, I want to bring into someone we talked to, and this is former hedge fund manager Michael Burry. He predicted the housing market's plunge. He spoke in an exclusive interview with our John Ehrlichman. Now, remember, his strategy paid off. He bet against bonds backed by the riskiest home loans. He helped his investors more than quintuple their money from 2000 to 2008. At this point, he still watches the real estate market, and he even invests in farmable land. As for housing, though, he's still worried. Big drag still.
There are a tremendous number of homes where the homeowner, I think it's somewhere between 2.5 and 3 million homes where the homeowners are more than 9 months past due and are not getting notices that they're past due. They're just living there for free. And I actually know one that's been there for a few years without having to pay anything. There's this, and I think that Fannie and Freddie are basically being used as special purpose vehicles by our government to support the housing market.
You know, and you guys were just talking about that, you know, the government and their role in terms of various programs. I guess my point with all of this is, whether it's housing or jobs, it's going to take a while to still work off the problems in those 2 areas. So, Jack, it could be a very tough environment for corporate profits ultimately and stocks for a while.
Absolutely. The simple fact is monetary policy requires borrowing to get to work, and as long as homeowners are over their heads in their homes and businesses are reluctant to advance, I just don't see how any kind of a monetary policy, whether it's overnight interest rates or quantitative easing, is really going to help prod this economy forward. So I am interested in hearing President Obama tomorrow. I do think perhaps there is some room for fiscal stimulus, at least targeted stimulus. But even here, as was mentioned, we've already got a $1.4 to $1.6 trillion deficit. The fact is, we don't want to have a $2 trillion deficit just to try to manage this cycle.
No, it's a good point. Michael, you agree? And ultimately, until we really deal and get out of the woods, if you will, with jobs and with housing, it's going to be tough. We might see a lot of volatility, but ultimately the market really doesn't go anywhere.
It's going to take time. I mean, look at the NASDAQ bubble. 10 years later, we're still at 2,200. That housing bubble lasted for three decades. Mm-hmm. It's going to take a long time. In 5, 6, 7 years, the housing is still going to be at the same price, if not a little bit lower. But we're not just going back to the go-go days of someone buying a house and then making $200,000 in a year. That nonsense is over with.
Hey, Jack, it's Adam. As I listen to you and Michael, you mentioned that your long bankers' acceptances, that's like a short-term IOU. But I would assume you would not go near bank stocks. Is that right?
Well, we actually had financial stocks in portfolio, and they were just remarkably cheap. had some positive momentum last year that allowed us to put them in portfolio. But I will say, their momentum has been sagging recently, and we've moved them to, I'll call a hold. And I would say within the next month or so, we'll likely kick them out of the portfolio.
All right, we got to go, guys. Listen, thank you so much. Jack Ablin of Harris Private Bank and Michael Seery of SeeryFutures.com.